Hi everybody, how are you tonight? Okay, so I see 4 people so far. Shad, I'm going to pick on you a minute here. Have you registered for classes yet? Okay, good. If you need any help to pick out which classes you need, feel free to email me. I'm actually going to be working tomorrow as well, and I think you maybe have changed to, all right, have you changed to a Richmond student but don't have a Richmond advisor, perhaps? Okay, I can request to have that done. I think I saw you on a list that's not changed over. So anyway, we can see what we can do with that. Has everyone else registered? Yeah. Okay, it's great that you've gotten registered. I think I ask you that every week, and we've been really pushing to get that done. We're going to have to cancel classes earlier this year. That's why it's important that you go ahead and get registered for classes. And any of your other classmates or people that you know, try to get them to sign up too. Okay. Has anyone started their homework? I really meant to look at that, and then I got in here and got playing around with other things and didn't. Yep, a couple yeses and a couple nos, maybe. Okay, well, hey, somebody got a few pages read. That's a start. We are doing Chapter 12. We skipped Chapter 11, so I hope you read Chapter 12, Blue, not Chapter 11. We're going to talk about cash flows. The chapter really goes pretty fast, I would say, and doesn't cover a lot of extra content. The main thing is to figure out the difference in the operating sections between the indirect and the direct method. The financing and investing sections are exactly the same regardless of which method you use. We'll do a little bit of, okay, now that we've done the cash flow, how do we know if the company's doing good or bad? And basically, you know, I zipped through the quiz earlier this evening. The quiz is probably the easiest quiz that you've had for the whole textbook, which should be a relief. And some of the homework will take you a little longer than maybe maybe you used to. Yeah, it's good to get some easy questions every now and then. Plus, we're moving forward into the holiday, of course, so you'll have a 2-week break of when you have to have assignments in, but you may want to push ahead onto Chapter 13 a little bit because things really get piled up as we move toward the end. You've got Chapter 13, then Exam 3, then you have the final exam all slamming in pretty fast. So if you get a chance over the break and you want to start Chapter 13 after you get Chapter 12 in, that would be great. Yeah, I'm looking forward to not having to go to work for a few days and trying to recoup, not necessarily rest, but to try to dig out my desk and get a little caught up too. So, you know, it's busy when we're trying to go to school and work. And well, I guess I was ignoring your email, Melinda. I hadn't even gone back and checked. I always open it and then I forget to go back and check it. So I'm glad you got in. Let me check real quick to make sure nobody else is out there trying to get in. Okay, Everybody looks like they're here. Okay, so let's talk about cash flows in depth a little bit and see if we can put some rationale behind what's going on. So the first thing that we need to do when we're in this chapter is identify the purposes of the cash flow. Why in the world do we even do a cash flow statement? We do this statement because it reports our cash inflows and our cash payments. We can look at it quickly and see how the company is spending their payments or their cash. And it can cover any period. It can be, if we do our monthly statements, we would do a monthly cash flow. If we do quarterly statements, we would do a quarterly cash flow. And if it's annual, we will do an annual. And you have to remember that the cash, when we get ready to do a cash statement, includes cash equivalent. So it's a little more than just your cash. Oh, Rebecca, really? Rebecca says she's going to be too busy next week making homemade caramels. That just, you know, that's not fair. Are you going to send us all some caramels? I have a sister who can make homemade caramel, and let me tell you why. I just don't have that skill. I'm not a candy maker. Okay, so we're going to look at our cash equivalents. Okay. I've got my computer mad at me. Not hard to do. Hang on a second. I'm fighting with my computer. I'm going to have to close it and then reopen, so hang on. Was it really bad? Did you get it out?
Oh, I let your buddy have it.
He's not my buddy. Which one?
The head of it, I'll let him have it.
You know who you are?
He's like, that's a public document for the setbacks. I was like, why doesn't anybody here have it?
Yeah. Well, let me do this and then I'll... Okay, sorry. We had a hot button activity happening in the county tonight, and my husband and son just came in, and my son wanted to know if I was recording or if he could tell me about it, and he really, I'm recording, right? So hang on just a sec. Okay, you should be able to see it again now. Okay, let's see. Okay, I got it going. Okay, are y'all still with me? I'm sorry about that. Just got really tangled up with my computer. Okay, so why do we do the cash flows? We need to be able to predict the future cash flows. It helps us to determine how much cash we can expect in the future. We can evaluate the management decisions. Are they making smart decisions with their investments? It determines the ability to pay dividends and interest. It shows a relationship of net income to cash flows. So it really helps us to see, you know, how the company is doing in a different light than just looking at their income. Timing of the financial statements. Of course, we would do the financial statements. The balance sheet is a specific point in time. It would have the date of December 31st or January 31st, whatever the specific date is. And all of our other financial statements, the income statement, the statement of stockholders' equity, a statement of cash flows, have the period of time for the period ended January 31st, for example, or for the year ended December 31st. We first have to be able to determine if the cash flows are going out of operating, investing, or financing, and that's going to be the trick when you get ready to do your homework. Can you identify which section of the cash flows it goes on? The operating section is going to have anything that is creating revenue, expenses, gains, and losses. So we're going to start with our net income, and we'll look at our current assets and current liabilities. Investing is cash flows related to any long-term assets. This is where if we're purchasing or selling equipment, we're buying land, selling land, we might have just a long-term investment in some type of other company. Those are all investings. Financing is anything we do to bring cash into the company of where we have either given up ownership or incurred debt. So this is going to be notes payable, bonds payable, both issuing those and paying them off. If we sell stock or issue stock, that's going to bring cash in. If we pay dividends, cash goes out. If we purchase back treasury stock, cash goes out, reduces our cash. So those are the three sections of the cash flow statement. So as we look at operating, investing, and financing a little more, the operating cash flows include our current assets, our current liabilities. Our long-term assets are investing, and our long-term liabilities and stockholders' equity sections affect our financing. There's two formats for doing the operating section. The indirect method is considered easier. More companies use the indirect method. However, the direct method is preferred by GAAP. But you don't have to do the direct method, but it is preferred by GAAP because they believe that it's easier for the users of the financial statement to understand. So with the indirect method, we reconcile from net income to net cash provided by operating activities. Basically what we are doing, if you want to think about it this way, is we are taking our accrual basis accounting statements, which in this class we do accrual basis accounting, and we're bringing it back to cash basis. With the direct method, we are actually reporting all cash receipts and cash payments from operating activities, so we are just analyzing it a little different. So a little bit of example at the bottom of the slide here shows net income, and then we would have to adjust for any non-cash transactions that were included in that in that net income originally, and these are things such as depreciation, because depreciation is a non-cash outlay expense, meaning when we record our depreciation, if you recall from our adjusting entries, it's always depreciation expense and accumulated depreciation. There is no cash involved in that transaction. The same as would relate to depreciation or if we have a gain or a loss when we sell a piece of equipment, those each do not truly affect cash. They are non-cash gains or losses, or depreciation is a non-cash expense. When we're using the direct method, we actually look at our collections from customers. We look at and analyze the different accounts and determine how much cash we actually collected from our customers. And then we take out any cash payments we actually made to suppliers. And that's going to provide our net cash per operating activities. It doesn't matter which method you use, you're going to have exactly the same cash flows in the end. There's two formats for operating activities. I think I just said that, didn't I? If we are doing the indirect method, there is a page in your textbook that shows a format for how you analyze this. Not really analyze, this is just how it works. You add depreciation, depletion, amortization back, you add back a loss, you subtract off a gain, we subtract any increase in current assets, we increase a decrease in current assets, we add an increase in current liabilities, and you can read through this table the same as I can read it. But this is adjusting our net income back to the cash basis. Again, the cash flows from investing is the same regardless of which method you use. If you spend money, it's a negative. If you bring in money, it's a positive. So you buy a piece of equipment, you're spending cash. You sell that piece of equipment, you're bringing in cash. And that's the same for our financing. If I sell stock, I get cash. If I pay dividends, I spend cash. Then I look at my cash increase and with my beginning cash, and it should equal. So I kind of have a built-in check figure. And we'll look at a few of these more as we go on. With the indirect method, again, to look at what's positive, our net income is positive or added, our depreciation and amortization, a loss is added, a decrease in current assets is added, and an increase in current liabilities is added. I'll try to give you some examples of why that is here in a little bit if you're somebody who has to know about why. Things that you subtract are net losses, a gain, a net loss being you don't have a net income, you have a net loss. You have a gain on the sale of a long-term asset, an increase in a current asset, or a decrease in a current liability. When we're doing investing, and this is what I'd said, if I sell a piece of equipment, such as a plant asset, I'm going to bring in cash, that's positive. If I collect a note receivable or a loan receivable, that's positive. If I buy plant assets or an acquisition, that's negative. Purchase of investments are not cash. If it's not a cash equivalent, purchase of that investment would subtract off from my investing. And if I loan money to others, then I have less cash because I have that receivable on my books. Financing, positive, is I issue stock, I sell my treasury stock, or I borrow money. Negative, I pay out dividends, purchase treasury stock, or I pay principal amounts of the debts. The interest amount goes under operating. So if we wanted to prepare a statement of cash flows by the indirect method, we'll look at Roadster Factory. They deal auto parts for sports cars, and we'll use the comparative balance sheets to do this with. So the first thing we need to do is analyze our changes. Do we have an increase or a decrease? Cash, while I say that we use look at current liabilities and current assets in the operating section, cash is not part of the operating section. That goes down at the bottom of our cash flows. But in this case, we had a decrease in cash of $8. And so what we're trying to identify with the cash flow is what caused that difference to be there. So looking at our income statement, we had revenues and gains, we had sales revenue, interest revenue, we had a gain on a plant asset, we had our cost of goods sold, salaries expenses, depreciation expense, and to get down to our net income. And what they're trying to show you here in the blue are these two items that are non-cash transactions. So we had a non-cash revenue and gain, it's a gain actually, and we had a non-cash expense. So when we get ready to do our statement, we will have to add those back to that financial statement, to the net income. So cash flows from operating activities, the transactions that make up the net income. You start with our net income, we add back our depreciation and our gains and losses. From the comparative balance sheets, we will look at our increases and decreases in our current liabilities and current assets. More specifics about what we're going to add and subtract. And here, using the financial statements we looked at, we started with our net income of $50,000. We have to add back our depreciation and add back our gain. So there's our depreciation expense. We had the gain of $8,000. We have to subtract that off. We had accounts receivables that increased by $15,000. What does that mean? It means that we had sales revenue included $15,000 that was not collected. How does that work? The way accounts receivable goes up is by recording sales. So we would have an increase in accounts receivables and an increase in sales, and we just hadn't collected that money, so we don't have the cash. And because we don't have that cash, an increase in a receivable is subtracted. And so we had our $15,000 receivable, and we had a $1,000 increase in our prepaid expenses as well. Both are current assets, so an increase in a current asset is a reduction on our cash flows. So we show those as negative numbers. We had a decrease in inventory, which also is a current asset. So if an increase in a current asset was subtracted, then it should stand to reason that a decrease in a current asset is added. So if my inventory amount went down, that would mean that I hadn't spent cash to purchase more inventory, or else I had sold more inventory, and either way my cash would be up. I either didn't spend it or I brought in more. So my decrease is added. I had accounts payable increased by $34,000. What makes accounts payable go up? Somebody, or I owe people more money. So if I owe them more money, that means I have not yet paid them. I did not spend my cash. My cash payments are therefore less than the expenses, and I still have more cash on hand. So keep in mind that an increase in a current liability increased my cash. I add this to my net income. We have salary and wage expense decreased, and accrued liabilities decreased. So what makes my liabilities go down? It means that I've paid more money out on them, right? So with current liabilities, if I have a decrease in a current liability, I have a decrease in cash. If I have an increase in a current liability, I have an increase in cash. So I just net all these together, and my net cash provided by operating activities for the Roadster factory is $77,000. Do you think that a $77,000 net cash provided for a company on their cash flow is good? Is it indicative of the company doing well or an indicative of the company not doing well? Yeah. Melinda says good. We have it depends on the company. Well, I think that you will find as you go through your homework that any positive cash flow from operating is considered good, right? So when we're looking at investing, and we'll just go through the investing here with the indirect method, and then you will remember that the investing is exactly the same under each method and the same with the financing. So as we look for this company, we had some, well, it's going to tell us that we have transactions that affect plant assets, investments, notes receivable, and if we increase these accounts, we have less cash. If we decrease them, we have more cash. It's just, these sections don't take analysis. Back to our favorite T account to figure this out. If we have a beginning balance of $219,000 and we bought $196,000 more of assets, we had a depreciation expense go out of $18,000, and we sold some assets that had a book value of $54,000. Then our ending balance is $343,000. What happened with this? We had a book value of $54,000. We had the gain. So how much cash did we get? $62,000, and that's what it would go on. Now, I don't think you have to analyze any of your homework problems in that direction, but this is good because it lets you see how if you don't have all the pieces, you can add that together and get your answers. Another way to look at your investments, if I had a beginning balance of $100,000, I bought $50,000 and my ending balance is $140,000, that means I had to have sold $10,000 with the book value investment sold. I mean, or that's how much I had to sell. You know, so how do I get from in notes receivable beginning balance of 0 to an ending balance of $21,000? That means I had to issue loans to folks for $21,000. Cash flows from financing activities. Same thing. It's going to affect our notes payable, bonds payables, long-term debts, common stock, paid-in capital, retained earnings. Most of these, this data is going to come from the balance sheet. Increases are offset by increases in cash, and decreases are offset by decreases in cash. A couple of examples of analysis. We just have some quick stop and thinks here. Can everyone see this slide, the stop and think slide? Or is it loading slow? Yep. Yep. Okay, you can see it. So just take a minute and look through these and in your head think which section of the financial statement would these go on of the cash flow. I'll give you a minute just to read through them. So the issuance of stock is going to go on the financing section. Borrowing long-term debt, financing. Sales revenue is going to hit the operating. Payment of dividends, financing. If we're buying land, that's going to go on investing. When we purchase back treasury stock, that will reduce our financing. Pay off bonds payable will reduce our financing. Interest expense goes under operating. Sales of equipment is investing. Cost of goods sold, operating. Purchase of other equipment, investing, and making a loan is investing. Would you have gotten most of those right? Yeah, most yes, yeah. And yeah, maybe if you used the book, yeah. But and I think this PowerPoint, you know, I'm not always a fan of PowerPoints, but I think that this chapter has really good PowerPoints too, very guided, and the book is really good. So if you go and you look at the mid-chapter summaries for the mid-chapter summary problem when you're getting ready to work on indirect methods, and if you look at the end of the chapter summary problem when you get ready to do direct, it will be extremely helpful to you, I believe. And I know you can use the Help Me Solve it too, but sometimes it's just really nice to see the whole picture all out, and that's what the book's better at than Help Me Solve it. So we also have a non-cash investing and financing activities sections at the bottom of our cash flow. Anytime that you've done some type of an acquisition for not cash, you want to list that if it's something that's major to the company, such as examples here where we bought a building by issuing common stock. We would want to show that. That increases our our investments in the buildings considerably. Here, buying land too, or we issued common stock to pay off debt. We gave up ownership basically to pay off debt, and so those are all important parts of information when investors are trying to decide if they want to invest. So here again, we're going to do a little look at an income statement. One of your homework problems, you actually do have to do an income statement and a balance sheet and a cash flow. So it's good that we come back and revisit what an income statement looks like a little bit here. This is a single-step income statement because it lists all of our revenues first and all of our expenses, and we don't have the cost of goods sold up there offsetting our revenue to get our gross profit. So if we had an acquisition of plant assets, $75,000 was paid in cash and $55,000 by signing a note. We had proceeds from sale of land. We had proceeds from common stock. We paid off some long-term notes, and we had a payment of dividends. So here's a balance sheet. Shows what our change is, whether it's positive or negative. So how are we going to do our cash flow? We start with our net income. Do you remember, did we have any depreciation? Yes. Did we have any gains or losses? I don't remember any gains or losses. Nope. So then we jump to our current assets and list each one of those. Then we had some current liabilities. We net it together for our net cash. I got really carried away there. Again, we had a positive net cash from operating. Our cash flows from investing, we had a sale of our land. If we sold land, it's positive, remember. We purchased plant assets. We spent cash for those. And we had a total of a negative $50,000. Is that bad? Is it bad that we have a negative $50,000 in cash flows from investing activities? Yeah, no, it's not bad. We're just investing in our company, and we had enough cash flows from operating to do that. As a matter of fact, we used $25,000 of the sale of our land and $50,000 from our cash flows to buy more equipment or more plant assets to hopefully make more money for our investors. I sold some stock or issued stock, got $50,000 cash, which, by the way, would have paid for my equipment that I bought as well. I paid off $16,000 toward my debt that I owed. I was still able to pay out $11,000 dividend and still come out with $23,000 positive. So here was just a summary of my numbers before so that I can see them. I had a net increase in cash of $74,200. I had a beginning balance of $5,800, which came right off my balance sheet. And when I add those two numbers together, it should equal my ending cash balance. In this case, it does. That's why I say we have kind of a built-in check figure when we're doing cash flows, because we should always have our net increase or decrease in cash plus our beginning balance will equal our ending balance in cash. Okay, we're going to look at the direct method. The direct method is more challenging for me because it's not a method that I've ever done. Real world, I always did indirect method in my real world position, so I always have to stop and really think and concentrate depending on what information they give me to do a direct method with. Again, FASB and IABSP, I said GAAP, but FASB and IASB prefer the direct method of reporting. They think it provides, again, I say, clear information about the sources of cash. It is used by a smaller percentage of companies. It requires more computations than indirect method. And again, investing and financing sections are unaffected. It doesn't matter which method you use. So when I use a direct method, I have operating activities. I have collections from my customers, receipt of interest and dividends on investments and other operating receipts. Those show up as positives. The negative amounts are payments to suppliers, payments to employees, payments to interest and expenses and income taxes, and other operating payments. So when I'm doing a direct method cash flow, I've got to be able to decide how much did I actually collect from my customers? Where does that amount come from? I would add any decrease in accounts receivable, subtract any increase in accounts receivable to get my sales revenue. Sometimes some of your problems will say that you had cash sales of so much and credit sales of so much, and so you need to look at or add those two amounts together. Your interest revenue, if I paid out a positive amount in interest revenue, or if my account increased, then I would add that. If it decreased, I would take it away. To get my suppliers, I add my inventory increases or decrease in inventory. I would subtract. Anyway, it's just a table. Again, you can read the same as I can to go through and read all of this. And you can follow these guidelines and get these cash flows right every time if you go back and look at them. Like I say, if I'm going to do a direct method cash flow, I'm going to pull out one of these tables and say, okay, I add this and I subtract this. Or if I'm in doubt, I pull the tables out and look. I know you're probably thinking, well, if you can't do it, then how am I supposed to be able to, right? So we're going to look at a little bit here. If I'm using a direct method, tell me where I would put each of these in the operating, investing, activity, financing, or if I don't use it. Well, net income, if I'm doing direct method, I don't even need that. Payment of I got crazy again. Payment of dividends is always going to go on financing, doesn't matter what method, long-term debt financing. Payment of cash to suppliers, that's operating under direct method. Making a loan is investing. Sell a treasury stock financing. Depreciation expense does not go on a direct method because we're not bringing our net income back to cash. Purchase of equipment is investing. If I issue stock, that's financing. Purchase another company with cash is investing. Payment of long-term note payable, financing. Payment of income taxes is operating. Collection from customers, operating. Accrual of interest revenue is not reported. Expiration of prepaid expense, not reported. And receipt of cash dividends is operating because that's something that's coming in from an investment. If I have a beginning accounts receivable of $81,000 and I had sales of $303,000 and my ending balance in accounts receivable are $96,000, then I would have collected $288,000. I can create this formula as well by saying sales of $303,000 minus my increase in accounts receivable. So this is how our little charts and tables work. I will analyze my inventory much the same. My accounts payable. Okay. So this is how to get my cost of goods sold. I would look and did I have an increase or a decrease in inventory and an increase or a decrease in accounts payable. And that's just how I come up with my amount that I use in my operating section of my cash flow. Okay. And all of this is right in your book, and all of this will be right in your Help Me Solves It as well. If I want to look at my free cash flow, that is actually my net cash provided by operating activities minus my cash payments earmarked for investments in plant assets. It's just something that I want to look at occasionally, and that's basically the slide. Any major questions? Does it look hard to you? Yeah, I just don't think, I think it's really laid out pretty nice, and right. It's not as difficult as some of the things that we've done. I used to think cash flows were really hard, but I like how this book talks about it and how this book expresses it and brings it out to you, and it should make it easier for you to understand by doing this.